With all that volatility at the end of last year, when we started talking in 2019, it was all about watching the GEs, the Anheuser-Busch's, the AT&Ts, the big corporations. Supposedly, corporate debt was going to have to go on this big diet. How did it all turn out, Peter?
They've actually been on a diet. I think the weaker companies have done a lot to improve their debt. GE's done asset sales. Budweiser did a huge bond deal that allowed them to refinance their debt and stretch out the maturity. AT&T did a similar deal, and AT&T has now tied their CEO compensation to balance sheet management. So I think people got the message. They're very careful about their balance sheet going forward, and that has helped the stock market rally.
Now, you know, there's also this ongoing worry that over the next couple of years, corporations are going to have to issue a lot because of maturing debt. Do you think that process, considering what you've just described and observed, is this going to send ripples into the market, or can the market accommodate?
I think the market can accommodate it, and I think people will be surprised just how much debt can be repaid out of free cash flow. Since the tax cuts, companies are generating a lot more free cash flow. I think we're going to see debt paid down very naturally, and companies are going to be very careful to maintain that, and we're not going to see this slew of downgrades that people were worried about. We're going to see BBB companies stay BBB, or maybe even over time get upgraded as they de-lever. So I'm very comfortable with U.S. corporate debt, especially in the investment grade space.
Let's switch gears. We just had former Treasury Secretary Summers, and to listen to him, boy, you'd never guess that we were in a record-setting first quarter. But the thing I want to concentrate on most is there is a difference, people, between hyperbole and talk and actions. You know, Peter Tchir, you watch the market as close as anybody. Do you sense that any of the Fed potential appointees like a Stephen Moore or an advisor like Larry Kudlow or the president himself has created edicts or actions or legislative policies to try to push the Fed under their thumb?
I don't think they've done so at all. If anything, I think some of the attempts may have backfired, because maybe that's why we did the rate hike in December, just to prove we're independent. I do believe the Fed is very independent. It's going to do its own things. I don't think we're going to get a rate cut. I do think balance sheet reduction should be ended. They're going to do things, but they're going to do it because the Fed believes it's right, not because it was tweeted about by some people.
Yeah, no, and I understand that this administration is different. They're disruptive. They're not necessarily sticking with precedent, but it certainly looks to me like it is more a talk than action. Finally, quickly, when you look up and you see all the different spreads between high yield and investment grade, do you think that they're too tight or just right, or do you think that they're going to continue to widen out a little bit with respect to high yield?
I think we're going to start seeing high yield weaken a little bit. It's been a very fast run. There's been a lot of inflows that have driven high yield spreads and prices much higher. So I think that's where we're going to see a pause on the high yield side.